All right, stocks finished on a high note. For a second straight week, we finished to the upside. Now with a 6-week winning streak on the S&P 500, which is not very common to get a win streak for this long on the S&P, which kind of puts the odds of a 7 week in a row win streak in jeopardy a little bit. We'll talk about kind of some of the signals that you're seeing, some of the technical signs, and just the strength of this rally in terms of what it's produced in terms of bullish signals to the upside. So we'll talk about that to see if whether or not we can actually get a trend started similar to other periods where we've had such strong returns. Now, a lot of those other periods did not coincide with such a strong rally in bonds that we've had over the past so many weeks. So we'll talk about other periods where bonds have rallied this much and see if those kind of things align. What's really driving a lot of this bullishness in both stocks and bonds, and whether that's correct, and see if there's any past precedent, especially in the last couple of years, for that type of move where they've both rallied so much. So we'll break all that down in today's video, take a look at what's driving. There is one huge outlier from an international standpoint that is not participating in this rally, as well as one pretty big outlier from a U.S. sector standpoint as well. And we'll talk about the significance of that, and then our trade idea as a stock in the banking sector that's kind of rebounded, but might starting to show some signs of divergence. So we'll talk about how to trade it. So let's go ahead and get started. Today is Friday, December the 8th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart, it opens up this tab, and hit that like button there. Again, click on this thumbs up icon, it opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. This was a big deal for us. That's why we always ask. Our goal is to get to 100 likes on our tweets. So those who do like this day in and day out, thank you very much. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished the week again for a second straight week. You can see that was last Friday, and then this is this Friday. We finished the week on a high note. Remember, it seemed like it was always Mondays that were the updates. Now it seems like we're Fridays are the updates here, especially the last couple of weeks, both finishing at the highs of the move. We actually did get another new 52-week closing high, and we got a new hot 52-week intraday high. So 4609 eclipsed the high of 4607 from earlier this year. So finally a new 52-week high here. The near-term line made its way back into the upper reversal zone again. And then momentum line, of course, falling down as it was already there before, and it doesn't stay there for very long. But at least it's still in bullish territory. The intermediate line maintaining a very long streak above the 90th percentile, and your market sentiment line now rising almost into bullish territory itself. So good end of the week for the S&P 500 with that jobs report. Same thing with the NASDAQ 100, that near-term line, which had been out of bullish territory for a while, a little bit more of a pullback than what we saw in the S&P, and then now is back, again up at strong bullish levels, even if the momentum line never did get there for the NASDAQ. Its intermediate line easily in bullish levels, and market sentiment line already has moved into bullish territory. The Russell 2000, you'll see, is not, obviously doesn't have a 52-week high, not even anywhere close. Got a cluster early in the week. On Monday, got a cluster on early in the week. And then has not exceeded where that cluster is. Got a little bit of a long shadow on Wednesday as well, with the drop to extreme lows on the momentum line. The near-term line did not get to the lower reversal zone, is now back in bullish territory along with the momentum line. So more of a bounce on the Russell, but not as bullish. The market sentiment still in bearish territory. The intermediate line is still in the upper reversal zone and in the 90th percentile. So it's just basically the Russell's playing catch up to, remember the S&P finally cleared this peak. So the Russell still got some more catch up to do if that's the trend that the market's going to persist in. Looking at the Dow Jones, I had already cleared that peak last week on the strong bullish move there, and then of course this week you pretty much stayed all right at the upper end of last Friday's range. So again, short-term sentiment is less bullish than what we see on the S&P, as we're not as bullish here on the rally. But you have strong intermediate line well above the 90th percentile, market sentiment rising almost into bullish territory. So, you got strong moves in the S&P and the NASDAQ, not so strong moves on a short-term basis in the Dow and the Russell. Though the Dow, it's interesting, the market sentiment isn't as bullish, but the Dow is way above these highs from earlier this year. The NASDAQ is also it's not as significantly above those July highs, but it has been above it for a while. And then, of course, the Russell, just like I said, way below those highs. Looking at the weekly market forecast, you can see the short-term line for the Russell. Here you can see the intermediate line is still rising. It's crossed above market sentiment. The near-term line is way in the upper reversal zone. Again, momentum line dipped its toe above it. They're on this first move higher in October. And then we've had this nice little strong 6-week rally here with that near-term line up above the moving average, which is now rising, so it's green. And you're probably just, again, next week you're going to get the dark green shading as that intermediate line rises above. You do have dark green shading in the green line. You've had it for a while on the weekly chart for the S&P. You cross back above the market sentiment. You're back into the upper reversal zone. Extremely bullish near-term line, even with the momentum line down in bearish territory. We are in that, kind of capped at that 5% above the 30-week. That can be a cap, as you've seen, and generally when you are strongly bullish, you exceed that cap, as you can see earlier in 2020, going into the bullishness there. Every one of these instances you exceeded that. So we'll see. We have held it for resistance in the past before exceeding it here earlier this summer. So we'll see if we hold it for resistance again or not. Looking at the Dow Jones Industrial Average weekly market forecast, its intermediate lines up there, strong near-term line crossing above market sentiment. So strong across the board for the market forecast chart on all of these major indexes. Let's look at some of the other weekly charts. You look at we've talked about the candle size is getting smaller. You ended up with a higher high and a higher close. For most of this week, we didn't have that. So the fact that we ended up, it goes to show again just how bullish we were. Again, we're going to start next week right around 45.42, and we're trading at 46.04. So it's going to be a smaller body again. The size of the body, which is the green line, is below its 3-period moving average. PPO is rising, but again, is not as bullish as it was earlier this summer yet, even though we're already to a slightly higher high there. You look at the NASDAQ 100, you can see the same thing. We are easily to a higher high in the NASDAQ. The NASDAQ produced a transition candle. It got a lower high and a lower close on there. So a little bit of a transition candle on the NASDAQ kind of portends something might be a little bit more bearish next week. Not the Russell. The Russell, you can see, it's got a strong candle again, easily clearing the 40-week exponential moving average. The size of the candle is very strong, has been. Now, in fact, the average has gotten really strong, so we'll see how that plays out next week and whether that will persist or not. One more weekly chart to look at, the Hull. We'll look at the daily, but you can see the Hull, the momentum line here is falling down as which is the MACD of where we are relative to the 200-day Hull. Obviously, the parabolic SARS flipped to the downside 5 or 6 weeks ago. You can see the candle starting to get smaller there. You can see that again on down there at the bottom. Here's the Qs. Looks very similar. And then, of course, IWM has just barely crossed above the 200-day Hull with the green 200-week Hull with the green line on the 20-week Hull. Parabolic SARS to the downside, and you can see the MACD histogram is kind of peaking there. Let's look at some of the daily oscillators. You have You don't have three green arrows yet. You're close, but you don't have it yet on the S&P. The Qs, the stochastics, actually got out of the reversal zone, so you do have a green arrow on that one. The diamonds never did not have three green arrows. It finally actually got a red arrow on its MACD for the first time on Friday, and then of course the Russell still has had three green arrows this entire time. So it's interesting that it's been more bearish during the bearish move, but it's been it hasn't been as neutral or in convergence mode as we've seen on these other oscillators. If you notice, you saw the histogram is negative. It's because the MACD is still below its moving average. Even with this rise, we're still easily above the 17-day. So we're still in convergence mode on the S&P 500. You're still in convergence mode on the Qs. You're not in convergence mode on IWM, as never did get the red arrow. You're still above the MACD. The stochastics has gone below its moving average again, but you're still way above the 17-day moving average here on the Russell 2000. Looking at some of the other oscillators, you can see the S&P again very strong. In fact, the ADX is back at 40, and we have our first orange arrow that ended up being the peak for the S&P back here, at least a short-term peak before we got that kind of divergent high point up there. Of course, the ADX wasn't as high then as it is now. It's interesting. The positive indicator is not nearly as bullish as it was there. So it's kind of rare for us to get an orange arrow where the negative line's below 10 and the positive line's not very strong. Looking at the Qs, you can see kind of we're not as bearish. And then finally, IWM, you can see it's been really late getting this move up to the upside. It's been playing a catch-up trade, but it's not below 10, but that is the lowest of the past 52 weeks. If I were to go back the last 2 years, you can see it's the lowest line for the negative indicator in the last 2 years as well, during all of this bearishness that we've had. We also look at the RSI and the CCI. You can see the CCI made a run up to 200. It was the highest move on the CCI, this entire bullishness that we've had. We finally kind of broke out on the S&P, got up to 200. The index did not do that. And the Russell 2000, you can see, had gotten to 200 here earlier. But the key is that weekly chart on the S&P is looking at, you can see the Russell had just barely crossed above 100 on the weekly CCI. So that's just barely a bullish signal there. But it's gotten these moves above 100 on each of these other peaks here and faltered. The S&P, you can see the weekly CCI is already rolling back over and potentially back below 100. And you can see some of the false peaks that we had there. Getting back below minus 100 would be kind of a sign of potentially another false peak, especially considering the CCI, RSI did not get very strong up to the upside. Looking at the Ichimoku cloud, still a very strong trend, way up above the green line, strong rate of change. That blue line's really starting to move up pretty rapidly. Same thing on the IWM. Now you have a mature bullish trend, so it's caught up to the S&P in that regard. So watch that, where we close relative to the green line over this next week to make sure we stay bullish. And then of course, this is the first time that the S&P has exceeded the 90th percentile. Just barely, but this whole rally, this is the first time that we've exceeded the 90th percentile, even as the bandwidth is way back down. Remember how we talked about how breaking the 150-day range is rare with a bullish move to the upside, but now we're already way back down there as the momentum is tapering off. The bands are moving inside the Keltner channels here. Looking at IWM, you can see we closed above the Keltner channel. Even with the momentum very strong and kind of rolling over as the band width appears to be starting to move to the downside here. So interesting move at some resistance. You're at the top of the value area. You're at a volume node, so we'll see if this ends up acting as a resistance for the Russell 2000. Let's look at the intraday chart. The S&P 500 did get a new high point. Look at this. We're only a couple of days away from the 4-week low really moving up significantly, like $12 to the upside, which means that this range, which is already, and it was also rare for a bullish move to take the price width channel from a 5% channel to a 10% channel. It's rare enough just to get to 10% at all on a bullish move, but especially rare coming from below 5%. So, so in other words, it's rare to get a breakout to the upside when you've been sideways. Usually you get a breakout to the downside when you've been sideways. But now you can, again, as low as it is already, in a couple of days, it's going to, unless we get a really strong new 4-week high point in the next 2 days, like of say $12, then you're going to drop hard on this indicator over the next couple of days. As again, we're really going to be tightening up this range here up to the upside. Because we got the new 4-week high point, we're 6 days away, so you're pretty much you're okay until expiration before you would get some kind of breakdown where the negative indicator is going to move up to 100. Usually that doesn't happen until after the green lines drop below 70. So you're probably going to end up with a really sideways action over the course of most of this week, at the worst, right? The worst case scenario. Of course, today's the range and the volumes had been relatively small. That wasn't the case. You're a little bit below average on the range. The ATR is still hovering right around that 4 level, but you're above average on the volume. So we haven't seen that in a while. And if you take a look at the volume and the trading range, 83 million's up here, and then the just over 4 points. That's a pretty good, like the ATR is pretty low. And it's kind of stagnant here. But again, that kind of goes to show that the market has been so bullish, and now it's kind of run out of buyers that can continue to overwhelm the sellers. You had enough buyers to match the sellers that are going on here, but you haven't had enough to continue the trend, like the momentum of the strong bullish trend up to the upside. That's also had an impact on the VIX. The VIX ended up closing again for how many weeks in a row now has this been, where we've closed below 13. 3 weeks in a row that we've closed below 13. This is the lowest close relative to the VXV. We're down to 81%, so near extreme lows relative to VXV. And you can see that VVIX dropped back down to almost 81. So you got a strong correlation at about 88% as the VVIX, which had ramped up in the last couple of weeks without an increase in the VIX, has now they've kind of moved back in the same direction, kind of like what we saw back over here, where the VVIX dropped back to where the VIX was before the increase, and you kind of had the same thing here, where you had the VVIX jump up, the VIX stayed down, that brought the correlation down, and then the correlation rallied as the VVIX came down before you had the move. So this is the drop in the VVIX before you get the move higher in volatility that's associated with this dip below zero. Not only a dip below zero, but a dip below 50%. You can see that over here as well, as the correlation turned back to positive before you had the big increase in volatility. A couple of waves of it there in late February and early March. All right, now let's take a look at what's driving the price action here this week. So let's go here instead to the asset class comparison chart. You can see the drop in commodities that we've had over the last little bit, and the rise in the Qs now being the outperformer for the past 3 months, overtaking gold, which had been briefly, temporarily, the outperformer for the past 3 months. Let's look at just here this week. So let's go to December, and we'll go to the beginning of the week here. I'll zoom out a little bit so we can see it a little bit better. You can see the bonds, incidentally, have been the best performer over the past week, and gold and commodities were big underperformers. Strong dollar, low yields, and low commodities, and that generally hasn't been that. Again, those three kind of moved in conjunction with each other. The only one that didn't move was the dollar, and that kept pressure on equities throughout most of the week until Friday. Equities still weren't up very much, 1% or less for the week. Very small moves in real estate and high yield as well. A couple other, at least real estate right now is a risk asset class, has been behaving as one. But the strong dollar really pushed down commodities, and because of commodities weakness, emerging markets really struggled here this week. If you take a look at that commodity move, big down a week. Look at that big crash through the 200-day moving average, dropping down to the one little volume node that you have below the value area from back in the summertime. We talked about this in our class on Friday, how crude oil tends to bottom, or excuse me, not crude oil, gasoline prices, sorry, tends to bottom out right around this time of the year. It lasts so many years. This is the time of year it bottomed out last year, the year before that. Before that, it was a little bit earlier in November. But this tends to be a time of where gasoline prices bottom. And we've just barely crossed below the 200-week moving average. You can see crude oil kind of sitting on its 200-week moving average, kind of bottoming out so far. The MACD histogram appears to be, at least it might be bottoming out. We'll see by the end of the week. The 8 and 17-week moving averages crossing below the 30 as we really broke below the 200 here and got to the bottom of the value area in crude oil over the last little bit, as the MACD is trying to figure out whether it wants to start moving up or not. So that was your big move on commodities. Bonds have really kind of filled in this gap between the 50 and 200-day moving averages. That's a big old MACD, one of the highest of the year. If I were to zoom out a little bit the last few years, you can see again one of the bigger moves that we've seen in bonds from a momentum standpoint. Of course, that means that 10-year yield declined and basically dropped down to its 200-week moving average before rising up at the end of the week, getting above the 8-day. You can see its MACD also down to low levels where it has bottomed out in the past. And the stochastics down there as well. From a weekly standpoint, this is what it looks like. You're sitting right on the 30-week average, and the MACD and stochastics down, though not very far. So we'll see how that ends up impacting things. And of course, your other big mover is your dollar, and the dollar this week jumped back up above its 8-week moving average, as you can see there. Of course, the daily chart, you're back above the 17-day with the MACD positive, so you were in convergence mode, but now you're in a bullish move. And we'll see if you're above the value area, easily above the 200-day moving average, but so far holding resistance at the 30-day moving average. So we'll see if it ends up holding and moving back towards the 200 or rising up again. This is having the most influence on equities lately is the dollar move. We've been looking at the rate of change over the last little bit. I want to take a look at that over the past 6 weeks. Let's go to the rate of change since this is the end of a week here. We'll go to the last 6 weeks now, adding on another week from the last time that we did this, and then we'll go to a weekly chart. So here we are finishing at 11. I need to move this line now. 11.82% for a 6-week return. You can see that's about matching what we got in November, coming off of that low right there in November. It's also about matching what we had there in August. We had a 6-week run that kind of started off of this low point, multiple 6-week runs of about this move, coming off of that low point, then again off of this low point for 6 weeks. Of course, not even, we only went 3 weeks to the upside there in March, but you can see the kind of moves again, very strong. The VIX was very high on both of these instances. It was very much higher on this one. You can see here coming off of the 2018 low point, again, the VIX was very high. You had a strong 6-week return of almost 12%. So you can see it's not out of the realm of possibility to get this kind of move. What again is so rare, there's your 2011. What is so rare is to get this kind of move when the VIX was just so low there in October. If you were to look at the one standard deviation move, for example, you notice this was actually one standard deviation was to 444.39. Of course, here over this past 6 weeks, we've gotten up in the SPY was actually up 12%, but we got the 460.20. So 449 here. Let's just go to a 1-day chart. 449. What was the one standard deviation? 449.39 was where that would be right. This would be a good bullish move to get to this point. Of course, we're at 460. and that's a little bit further along than just one standard deviation. In fact, if you were to move this over, or just put this at the 460, whatever, I don't even know what it ended up being, 460.20. So you can see that not quite a 2 standard deviation move, but pretty darn close. Only a 7% probability, well beyond the 1 standard deviation move from, again, that low point at 410 with a lower volatility now or then than what we have right now by almost 9 percentage points. So needless to say, it's a strong move. It's this has been a strong 6-week rally, but it's not just been in equities, as I mentioned. You can see the 6-week rally that we've had in bonds is one of your bigger 6 weeks rallies. I mean, we did come off of the highs, but if I were to go to the history of this, there's only been a literal handful of other times that we've had this big of a move over 6 weeks. Over the course of this, 1, 2, 3, 4. It's actually 7 weeks because bonds rallied one more week prior to the equity market. So over 7 weeks, you can see, again, coming off of the highs, we were higher earlier in the day. So if I were to change this here, if it will let me. There we go. My cursor, mouse isn't working. You can see here, again, a literal handful of other times that we've had this big of a move in bonds. One of them being the last time the market was pricing in rate cuts. And then, of course, in COVID, the credit crisis, and the washout with like Lehman Brothers and washout phase of the bear market. And again, we talk about the Fed. If you look at where the markets or what the markets are pricing in, you can see the markets are still pricing in rate cuts by next June. In fact, you have a 93% chance of rate cuts, and you're about a 60% chance of 2 rate cuts by June. The odds of 1 rate cut by March has dropped down from being over 63% a week ago to now only being 43%. So that's dropped down, but still you get 2 rate cuts. If I were to go to this meeting back in May of earlier this year, right in this time frame, again, at that time, we were 50 basis points lower. So at the time, right now, we are at 5.25 to 5.5%. So back over here in May, we were at 4.75 to 5%. So you can see the market was pricing in 2 rate cuts at this meeting as late as May. Right here, as late as May, you can see there was a 100% chance, 99% chance of a rate cut by now. By next week's meeting, back in May 10th, there was an 80% chance that we'd have 2 rate cuts back in May 10th. Of course, we didn't get 2 rate cuts this year. We had 2 rate hikes this year. So you can see the market has been pricing in rate cuts before. This isn't the first time. Obviously, last August, they were pricing in rate cuts. You saw at the end of the year with that strong move in the bond market, they were pricing in rate cuts back over here. You can see there's that move. The move in August right there. They were pricing in rate cuts often extremely low. But, of course, here they're pricing in rate cuts. I said in May, right over here, they're pricing in rate cuts with this rise that we had in bonds. And then, of course, now we're pricing in rate cuts again to a very, very large degree. So the question now, of course, is will the markets be right this time? Again, the bond market's not pricing in the rate cuts. As you can see, we're still here at 5.4%. So we're still actually at the higher end of this range between 5.25 and 5.5. And then you look at the 2-year, and you notice again, the last time we raised rates was back here in July. And we are pretty much at the same level, about 10 basis points lower than we were then at the last time we had a rate hike. So this is where the market is, the bond market is for this particular, where the market is for the Fed funds is now, and it hasn't moved. It's gone up and it's gone back down, but we're pretty much at the same levels as we were there. So even the bond market's not pricing in, at least the short term. It's just the long-term market. And as a result, you have a significant move in the yield curve. As you can see, it's back down to 50 basis points here on the yield curve. And then especially here on this yield curve, you had dropped all the way down to 125 basis points after topping here at 50 basis points. So big change, which again tells us that the short-term bond market is not pricing in rate cuts. The long-term bond market is. The stock market obviously is. Commodities, as you can see, aren't necessarily pricing in. As you can see, commodities have had their struggles over the past however many weeks, right? Going back, the same 1, 2, 3, 4, 5, 6, 7 weeks, right? We're down about 8.5%, which is a pretty decent drop. There's been bigger drops, but that's a pretty decent drop over 7 weeks. So you can see even commodities. But as we've seen in the past, especially with crude oil, that this tends to be a time of year where crude oil bottoms, at least ends its decline. As you can see, you've had some pretty significant momentum. 1, 2, see, it would be now 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks really of decline. So if I were to change this up to include the where we really started the move to the downside, at one point in time we were down 21.5% over that 10 weeks. It's a pretty decent move in commodities. And the question is whether or not that's going to persist, as well as what the bond market is doing is going to persist, as we are hitting some important support on crude oil right around the $70 a barrel mark. If you take a look at how the sectors have performed this week, let's see how our, you can see XLK, XLC are doing pretty well over the past 3 months. That's to be expected, right? They're kind of your main risk appetite trade. Let's go to just this week here, and we'll come out to 15 minutes. Remember, with the dollar strong, but in bonds strong, bond yields down, and commodities down, you can see the bigger mover to the upside. The commodities really impacting materials and energy. But look at XLK, XLY, and XLC were your biggest movers today, this week, excuse me, up over, 1%, roughly over 1%. If I were to zoom all the way back out to where this whole rally started, you can see that we've got a pretty decent move in discretionary and technology. Communication services started to lag here. And then you have financials and industrial. Real estate, remember, has been behaving kind of like as a fourth risk appetite sector. Then you have financials and industrials doing pretty well. Energy down 3%. So the market's been, moving up nearly 12% over this past, 6 weeks. And energy is down 3% or almost 3% off of its lows. Your safety sectors are still up 5 to 7, 8% here. So they're still showing some strength. Despite the strong move in risk appetite. If you take a look at the 12 grid for these sectors, you can see the strength that we have kind of broadly here across all these areas, XLK, XLY, XLC, except for energy, and materials are showing a light pink shading. You've got some clusters, we've had some clusters in some of these areas, and there's real estate. Everything else, still looking pretty strong, even though the numbers themselves for 3-month returns do not look so great. I mean, you're actually negative on materials. You're down 10% on energy in the past 3 months. Discretionary is actually down over 3 months, and utilities as well. Real estate, technology, real estate, communication services, along with financials, kind of your better bets right now over the past 3 months, with some weakness in other areas. So as strong as a 6-week run has been, when you put it in context of the 3-month return, it hasn't been that big of a move. So it kind of puts in the context the run from the perspective of the decline that we had previously. Let's look at the 12 grid for the major economies out there, the ETFs that track stocks in those economies. Of course, China just hammered down 13%, dark pink shading and a red line. It's putting pressure on Korea on a relative basis. Everything else, especially in Europe, just looking really, really strong. India, of course, maintaining strong relative strength. You're getting some clusters here in France, a cluster there in France. Brazil, strong returns over 3 months. So it's kind of an outlier there in China, and you wonder how much longer that's going to continue to be an outlier, whether it's going to join the party or whether the party is going to, come down to that and fill in the divergence that it's had with, again, the world's second biggest economy out there. All right, if you take a look at our trade idea of the day, it's actually on Morgan Stanley. The financial sectors really come off of some real significant lows in October, much more significant than some of the other areas. So you've really rallied up on like Morgan Stanley has gotten dark green shading the green line, bullish patterns across the board. If you look at the this pattern, you are back to the, you're above the 10 week, but you're not quite above the 40 week yet. PPO is still negative, and it appears like the strength of the move, the momentum of the move is declining. If you take a look at this chart, the MACD is already, the histogram is already peaked. The MACD itself is already peaked. The stochastics is diverging as we're heading into some very strong resistance here. You're in the value area at least, so that's a good sign, and you're kind of filling in the gap between the 200 and the 50-day moving average. But it appears that you might be losing some of the momentum that we had. You're above the cloud, which is a good sign. You have good intermediate trend strength going on down there. The RSI and the CCI look, relatively decent, not jumping off the page. And then looking at the Bollinger Bands, you can see we are in the upper quartile of a bandwidth that's declining pretty rapidly. You're closing above the Keltner channels again, and that was a sign. That was kind of a top the last few times we've closed above the Keltner channels. So what I decided to do here is to say, okay, let's take a look at selling an iron condor on this. We're going to come over here and sell the 77.5, the low 20s delta. And then we'll also sell the 87.5 by the 90 by the 75. So you get a pretty decent credit. If I were to right click on this and analyze this trade, you can see where the break evens end up being. If I were to put those onto the chart themselves, you've got support at that moving average, especially that 30-day moving average where our lower break even is. You see that there. And then the upper break even, you've got some old highs, some touches above the 200-day moving average, the point of control, the big volume nodes up there. So, again, the divergence might, we're pretty strongly bullish. I'm not as worried about the downside, and we're perfectly, we're hedged to the downside. That's not a problem at all. We're more worried about upside move, and you got strong resistance with divergence showing up on some of these oscillators. We didn't really look at the RSI and the CCI. But we did. The DMI is the one that we didn't look at. The DMI here. You can see how significantly low that negative indicator is. We've been lower there time in June, but all the other instances, it kind of peaked right around this level. There, and a few times over here as well. So this is getting to 15 is a pretty low level. Especially with the positive indicator already above 35, which is not very common for this individual stock as they get to that level too. So I think our momentum to the upside is down, slowing down, so we can take advantage of this sideways action, try to sell that volatility starting to come back in, and maybe kind of going sideways here, going into that January expiration date. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.